word, and since I messed that up last time. Okay, and can everybody see that screen?
Yes.
Okay, great. Hey, Karina, just saw you joined. Okay, so this topic, this is traditional versus Roth and kind of lifetime tax management. Bottom line, I believe too often people only look at taxes in the current year and how to avoid paying them today, whereas you should look at them as a whole life perspective and could save thousands, up to hundreds of thousands, even $1 million potentially. This is important because you could inadvertently pay far too many taxes or get hit with a big tax bomb later by being short-sighted today. And hopefully when I'm done with this, what I'd like you to be able to do is be able to holistically consider your current tax rate and current level of taxes you're paying, and consider whether you should adjust your contributions to be maybe some more Roth or even traditional, or how do you want to split that up, but really to think about it. Let's see. And if I can advance, okay. The required disclaimer, as mentioned, this is for educational purposes only, and this is no specific recommendations or advice. It's not sanctioned or supported. I had to add or supported by Viasat. That was the only thing legal made me change on my disclaimer. But if you need, real advice, talk to an appropriate professional. I also wanted, would you guys all, I did get approval. They told me really I should probably get actually a written release later, but knowing that I can't post these recordings on the Viasat website, would you guys be okay if I was able to post this on like say a personal website where people could then download the recordings, so that they could have those? Because I know some people like to review the recordings and actually maybe pause it and stuff like that. If everybody give me a thumbs up and you agree to that, and this is for free stuff, so I'm not paying anybody for that, but if you all give me a thumbs up.
Yeah, fine by me.
Okay, thanks. Jim and Karina, those are the only two I haven't seen.
Yeah, I'm good.
Good, okay, thanks, Jim. Karina?
Karina said yeah in the Slack.
Oh, did you? Okay, I didn't see it, thanks. Okay.
Yeah, Alan, thank you for having me.
You're welcome. And then it's, let's see, I see there's already a couple chats, but I got to pull that up. Okay, good, I see it, yep. Unfortunately, it doesn't always show. Okay, before we really get rolling, one thing I wanted to first bring up is open up your IRAs this weekend if you haven't already. Does everybody already have a Roth IRA? And have they contributed to 2021?
Yes.
The max. Who does not have a Roth IRA yet?
I want to say I have, but I have not contributed just because I've been unemployed for it.
Okay. If you haven't, you've got just until the 18th. Why I said open them up if you haven't is because it takes a few days. You can open up the account quickly, but then you got to get your checking account or savings account, whatever you use to so that you can fund that account. And that usually takes a couple of business days because they send those little stupid 2 little deposits. And that I mean, it sounds stupid, but it's important for security, but that takes a couple of days, and then you'd have time to fund the account and use 2021 money. So Karina, check if you have your IRA already. If you and then if you can fund it, if what you want to do is fund that for 2021, and that's a specific thing you need to check, that you're funding for 2021, because that's only until the 18th of this month, and then you have till tax day to fund 2022. If you're above the income limits, which we'll show in a second, I say open both because you'll probably need a traditional and a Roth. And hey, Matthew and Dustin, I know you both joined. Dustin, this stuff you already know. We already talked about, but Matthew, I don't know if you've already opened up an IRA?
I sure have. Yeah.
Okay.
I made a good move. Yep.
Okay.
I maxed out my contribution for the year. Yep.
For 2021 and 2022 or 2021?
No, just last year. Yep.
Okay, good. That's the thing. If you've got another 10 days, to contribute to 2021, then that window goes away. So, whatever you have, get 2021 completed, and then additional can go into 2022. I did, Dustin and Matt, I already gave the disclaimer out. This isn't advice or recommendations. And also, I got permission. Wanted to see if you guys are okay with me putting this on like a personal website so people can download the recording. If you guys are good with that. And like I said, this is just for people to download for free. So I'm not paying anything, but I noticed in every release I saw it specifically said to mention that. Are you guys good with this? Matthew and Dustin.
Oh, yeah.
Okay. Matthew, you good with that?
Yep. That's good.
Okay, cool. Okay, I want to quickly put up also the income limits for IRAs as well. If you're below the income limits for the Roth IRA, you do not, the whole backdooring thing and the traditional, you don't need to worry about. You can contribute directly. If you are above the limits, and we've already talked about the pro rata rule, et cetera, before, that's complicated. So if you have a bunch in a traditional IRA, you can't really do the backdoor. But if you don't, this is how you do the backdoor Roth IRA. Contribute a non-deductible contribution to the traditional IRA. That's why I said you need to open up both. Shove that money in. That'll take a day or two to settle. And then you convert that traditional IRA to Roth IRA. It'll give you an option to keep, close the account or keep the traditional account open. Keep it open. It'll just sit there at $0. But bam, now you just moved all the money into a Roth. Invest that money into whatever securities you want. Tax-free growth forever, and you want to pay any taxes. What was I going to say? That makes it a conversion. There's, it's instead of a contribution, that's a conversion, and there are 5-year rules on that. But we'll go into that. That's beyond the scope for today, and we'll just go on. Okay, so here's the agenda for today. We're talking about our tax system. It's progressive, and we'll go into effective tax rates, and all these other items as well. Okay, real quick question. So what do you guys? A lot of you probably did your taxes. Did you get a big refund check, and do you like that?
Still haven't done mine yet.
I did not
do you-
get a big refund.
I'm going to owe
What's that?
money. It's the accelerated child tax credit that got me.
Well, a lot of people always, and especially younger, always liked a big refund. And it's like, that's what I think about that. You're giving the IRS, the government, a free, interest-free loan. Instead, update your withholdings, and you want to be close to zero if you can, because and then it's, some people might have imagine if you had say a $6,000 return, but you didn't contribute to your Roth IRA during the year because you didn't have enough money. Well, you had enough money. You could have been putting $500 a month away into the Roth instead of just letting the government take it. So and hold it for you interest free. But anyway, don't go for a big refund. Granted, savings accounts are very poor interest right now, but still, it's better than having your money to figure out what you want to do with it instead of letting the government hold it. Okay, so outside of tax, I want to talk quickly about taxes that we cannot defer, and those, payroll taxes, which are Social Security, Medicare, breaks down the numbers right there. And these are limited, like Social Security changes each year, but it's up to like 147K, that amount of income. After that, you don't get any Social Security tax. And that'll probably, they'll adjust that each year. And that's one of the ways they'll keep Social Security going. Medicare, there's no income cap, but it's only 1.45%. And then same thing with the California state disability, which I know most people here, except Matthew, I know you're not a California resident, but probably something similar in Arizona, but not as bad. California's the worst for taxes. If you're self-employed too, you have to, what's that?
No, just nice. Yeah. That,
Oh yeah.
Being an Arizona resident, high tier. Yeah.
Yeah. Let's see, and if you're self-employed, understand that you would have to pay both the employee and the employer. That's just something, if you down the road get into your own business, you end up paying about 15% total for yourself, because you're covering both the employee and the employer portion of Social Security, FICA taxes. Okay, here just quick understanding of terms. There's so many different, like when you're figuring out taxes, you're like, okay, there's gross income, there's adjusted gross income. What's taxable income versus this? What's MAGI? So I just kind of defined these, so that you can understand where they're at on the tax forms. Really, there's a very little exclusions from income on gross income. I could go into those details in email later if you want. Adjusted gross income, that adjustments to income, that's like your 401k, traditional 401k allotments that subtracts out from your adjusted gross income. And then from your adjusted gross income, that's where you take out the standard deduction, or very few people use it anymore. It used to be about a third. Now only about, with the increase in the standard deduction, only about 10% of people use an itemized deduction. And really you need either probably one, you need to own a home and be paying the ridiculous property taxes in California, or have your own business where you have probably some business deductions, but otherwise a lot of people don't. Or you could do a huge amount of charitable deductions. That's another way, but that's a specific topic on charitable deductions that I like to talk into, and a smart way to do that. And then MAGI, that's what determines Roth limits and other limits. And really all it does is add back some things that probably most people don't really have. Things like municipal bonds, interest from that, which isn't taxable, but for determining your MAGI, it is. So any questions here? Okay, and then we'll just go into, here's kind of effective tax rate. People think of in your tax bracket, but it's graduated. So you get a certain amount taxed in each part, and then so your effective tax rate is really not what tax bracket you're in. And then I just use this assumptions. When you guys see these examples coming up later, you'll understand what I'm saying as far as effective tax rate versus the actual tax bracket that you're in based on the incomes I'm using. And these are, just so you can see on your own, at 1040, what these lines are, but we're just saying, hey, total tax versus taxable income. And there's a couple different ways you could actually look at it. Another way would be just looking at gross income as the denominator, but we could jump into that later overall. But one of the things I wanted to bring up though, and you'll see in these upcoming examples, we don't know what taxes are going to be 20 years from now, et cetera. And that's kind of the challenge of, what's your tax bracket going to be when you retire, whether you go Roth or not, all in Roth or all in traditional. I think there's a blend. And I think my thought is when you're young and you're in a low tax bracket, hit up that Roth as much as you can. Nobody complains about tax-free growth, tax-free earnings, income when they're retired. But as your salary increases and you get into a higher and higher tax bracket, that's when you start using more traditional, and hopefully then convert later when you're retired and your income's lower and you're hopefully in a lower tax bracket, but that could backfire. And that's why I wanted to talk about this. And, oh, we don't know what taxes are going to be, but we do know the Tax Cuts and Jobs Act is sunsetting at the latest January 1st, 2026. So we know tax rates are going to go up, probably sooner, based on, what the administration has been trying to do. But even by then, so there's a window right now where we have relatively low taxes historically. This graph here just shows, where we're at. The blue is the highest, the maximum tax rate, and the red is the lowest, tax rate. But you can see in terms of history, we're pretty low here, relatively speaking, on overall tax rates compared to historical. And we know the Tax Cut and Jobs Act are going away. So this might be a window where you're in a better tax bracket than you will be in a few more years, which, like, I'm actually doing. So I'm putting a little more Roth than I would normally. And before I get hit into a higher tax bracket when that goes sunsets. Here's a quick timeline. I just wanted to put up a few kind of, you could just take a look, but just some kind of key numbers here. When the year people turn 50, I'm just making an assumption of, hey, somebody's starting working at 25, good earning, and then a couple examples where they work for 30 years or 40 years, and then some specific dates for like when you can take money out of these accounts, etc. A couple of key numbers up here. Once the year you turn 50, you can start adding in another $6,500 to your 401k contributions, and you can also add another $1,000 right now to your IRA contributions. And they're actually, something's proved through the House, they'll actually bump those up as people get even older, closer to, in their 60s, I think. But these are just some different things I put down here, like Social Security you could get at 62, but you're going to take a 30% haircut on your lifetime earnings. If you start then, instead of taking it your full retirement age, which is currently 67. And then if you waited till you were 70, you'd get an 8% increase, forever on your Social Security, which is a good lifetime, longevity hedge if you can make it to 70 without taking that money. Any questions on this? I know there's a lot of stuff here, but I figured you guys would provide some, I think, good things, considerations of overall as people age. Okay, now here's some assumptions that we'll use before as we go into the examples that I used for creating these examples. Only accounting for 401k and HSA as deductions. I'm not talking child credit, etc. And that, like I said, we know the Tax Cut and Jobs Act, that's TCJA, will sunset. I'm using the same tax rates that they had in 2017 before that. And then I'd said 10% contributions for the first example at 75K salary, and then max contributions, maxing out the 401k contributions after that, and the HSA contributions. Okay, if you guys want, maybe take a snapshot of these if you want, real quick, and that way you can see these as we're going through the examples, because I don't have the tax rates. I just show what the tax rates are. So this shows our current tax rates that we're at for 2022, the standard deduction and the SALT tax, which or SALT deduction, which hopefully that'll change as well and go back to, because $10,000 is nothing especially for California and New York residents. Here's another one. This shows our current tax rates, federal tax rates, versus the 2017 tax rates, which is the ones I'm comparing. And then here's the California tax rates for 2022. and capital gains, which capital gains, I'll probably need a topic just on that to explain how that rides on top of your income and but capital gains harvesting, tax loss harvesting, that's all an interesting topic, but I think it's worthy of its own discussion because it can go deep and it's kind of confusing. Okay, so first example, this is showing the federal taxes for single person.
Hey, Alan,
Yeah.
can you quickly go back to the
Yep.
California tax rate so I can grab that one?
Yep. Yeah, sorry, Jensen.
Oh, it's all good. All right, I got it. Thanks.
Okay. And I'll shoot these out later. I'm just saying, just as we're going through, if people wanted, to be able to see it at the same time, I figured it's worth taking a quick snapshot. Okay, so here, and I'll quickly just let you see, I'm assuming everybody's the single salaries over here, and then the different rows, you can see I say what's gross income, 401k contributions, like I said, for this one, it's 10%. HSA contributions, adjusted gross income. We're only using the standard deduction, and then what your taxable income is, and then what tax you're going to pay. Over on these first two columns are just comparing traditional versus Roth, and that's going, all one or the other. And then here, since looking at post, the Tax Cut and Jobs Act, when that sunsets, what this same person would be paying in taxes and their effective tax rate, what federal tax bracket you are in. And if you see here, like it says 22% for 9,125, you're in the lower tax bracket below that. So most of it's at 10 and 12%, but then you slide into 22% for 9,125. Does that make sense? Just make sure that's clear. And then the same thing for the Roth, obviously, there's a larger portion of that that's taxed at that 22%. But then this, like I said, even though whatever tax rate you're in, this is what your actual effective tax rate is. And notice, it might not seem much of a difference, but this is like compared to the tax rate, it's almost a 20% tax rate savings right now compared to when Tax Cut and Jobs Act ends. So it's no joke. It's a decent amount of money, and that's one thing we know is going to go away. Okay, here's also, I have to add in California taxes. Matt, you should just be smiling because you don't have to deal with this near as poorly. But this shows how, what additional taxes we'll have. And then a total effective tax rate on this, you see at the bottom, that's inclusive of both federal and California taxes. Which also goes into, if you retire outside of California, that's a slide later, and you start doing conversions, you avoid the state tax, which can be significant. But that's again, unless you know already what you're going to do. Okay. Why is this in here? Oh, I did put in here an example of your max contributions. If somebody was making 75K, and you see how noticeably different their federal taxes for the traditional IRA, and the same thing for someone making max contributions. You notice here, California doesn't deduct HSA contributions. It's one of two states, or maybe now the only state that doesn't deduct that, but you still get the federal tax deduction, which is significant. So it's not a reason not to do HSA. Okay, now going on to the next level, and you'll see how your tax rates keep getting higher, and the much more taxes you're paying as you get larger. So this would be a single person making 125K and maxing out their contributions. You see right down here, how much tax you're actually paying, and then the effective tax rate. And you see you're still, 15 and 13% better tax rates than when those sunset. So that's why I say, hey, still, it still might be a good idea to push some into Roth now, some additional before tax rates go higher and you're just paying a much larger rate. So take advantage of these lower historical tax rates. And then once again, there's California numbers. Okay. And then this is where I went into example I kind of highlighted, because it's where you jump up 8% higher tax bracket. So that's significant difference, where you're like, I don't want to pay 32% tax. So in this case, it's a single person making 200K. Suddenly they're in the 32% tax bracket for $13,350. That would be my thought, where I would shove 13,350 at this point into traditional, and then fill up the 24% tax bracket with Roth. Though, does that make sense? So of your 20,500, put a 7,150 in Roth, and then the rest in traditional, and then you've avoided this 8% increase for that tax, that amount of money. Yet you're still also continuing to fill up, that Roth bucket that so many people lack. Any questions here? Okay. And same, here's just the same tax rates, California tax rates, no
Alan?
difference there. Yep.
Are we still talking about IRA or 401k?
This is all 401k.
Oh, okay.
Yep. Sorry, Dustin. I just did that IRA stuff right at the beginning because we're 10 days away from the end of 2021 contributions of whether 2021 contributions can be made. So I wanted to touch on that first. If people hadn't opened up their Roth IRA yet, do it right now. And now this is all just really talking about the 401k.
Okay. One question though.
Go ahead.
How does it work with taxes when you do a backdoor, the conversion?
Okay. So you're okay in general, and this we can, if we need to at the end, Dustin, I'll go back to the different presentation where I went into the pro rata rule. If you have no money in your traditional IRA, when you first, and then you contribute this, $6,000 to that traditional IRA, that's already after tax money, right? It comes out of your checking account or what savings account. You've already paid taxes on that money. So then the money settles in that account and you convert it to the Roth. It's just cash. You've made no earnings. You paid no tax. Now it's sitting in the Roth. You invest it, buy into whatever index funds or what have you, and then tax-free growth forever. So you don't pay any tax, but you cannot deduct that on your taxes. So it's a non-deductible contribution to the traditional IRA, and then you convert it, and you pay zero in taxes. I've done it several years in a row. It's no problem, and it's just a tax form like 8606 or some simple form you'll get that explains, that lets the IRS know what you did. But yeah, you pay zero taxes. Does that make sense? And then we'll get in, remind me at the end, if you guys have time, we'll go back into the pro rata rule, which if you have a ton of money in a traditional IRA that you've not paid any taxes on, like say you rolled an old 401k into a traditional IRA, et cetera, then the backdoor is an issue. And we'll talk about that in the pro rata rule if anybody wants to review that. Good. Okay. And now this is the same example. You see, I'm kind of doing married and then doubling a single and married and just doubling the income. And you kind of see whether it gets to be a little bit of a penalty for married people let down the road as their income increases. But Once again, I highlighted here, for a married couple, if they're making 400K, you could throw 16,700 into traditional IRA, the rest of that 41,000 go Roth, and you'd fill up the 24% tax bracket, and have be filling up both Roth and traditional to get that absolute flexibility long term. And here's the same, just California tax rates for that. Okay, and then I had a couple of, these more examples of a single person making 250K. I know, and Christian, I know before we talked about, I get these kind of crazy numbers, like $1 million income, and I'm gonna wish I had something like that. But the whole point of this is showing as your income goes up, which hopefully people does over the life of their career, they keep getting higher and higher tax bracket, and so that's my point of go Roth early, and then you start shifting towards traditional later, but giving you that nice trifecta of some Roth, some traditional, and then some brokerage, ultimately long term for maximum lifetime tax management. Okay. And let's see. I think I did the same slide. Okay. And note on here for people, once they make 250K, there's an additional net investment income tax for any interest, dividends, capital gains, etc. So while people think of capital gains as a 15%, it actually goes to 20%. There's several other little taxes that you get on, and they're not so little, so something to be concerned about. Okay, that was the same. Okay, this is for a married couple at 500K. Notice suddenly they're in the 35% tax bracket, whereas the single was not as at 250K was not even there yet. Oh, disregard. I got that wrong. I thought that was okay. And then here's the, you start seeing just how much you're paying in taxes as your income goes up. Okay, and then here's for, like I said, these are. I wish I had $1 million salary or 500K, but look at you're at the highest tax bracket. Sorry, I kind of blazed through the single at 500K, but you're well in the 35K, 35% tax bracket. I'd be going all traditional, right? That you're not hopefully going to have that kind of tax bracket when you retire, unless you have a ton of passive income or other income coming in. So push all traditional as much as you can to minimize whatever taxes you can. And yeah, for married couples, that they're at the 37, and then the nearly 40% once the Tax Cuts and Jobs Act, which really makes it about 50, just over 50% when you're in California because of that 9.3% effective tax bracket, or sorry, yeah, it's 11.3, but still ends up being about 9.3%. Okay, catch-up contributions. Some people are only about efficiency, and then there's other people that kind of, I like to think of flexibility is thinking of that as well as it's straight tax efficiency. Catch-up contributions are $6,500. Additionally, you can do $1,000 for IRA. If you're 49 and you can contribute, say this year, 20,500, and you turn 50 in 2023. If you were already contributing that max, and then you're putting, say, 6,500 into a brokerage account, you've already been taxed. You're already used to getting taxed on that $6,500, right? but then it's going into a brokerage account, which then you pay capital gains taxes on. So since you're already used to paying that tax, if you've already maxed out previously when you're 49 and then contributed to hopefully to a brokerage as well, then you're used to paying that tax. And since most people need more Roth bucket, why not just put it in Roth and have that additional, tax-free growth forever? It's too many people don't have enough in their Roth bucket, and I don't, how the government seems to be wanting to end Roth at some point. I think anybody, you'll get grandfathered in, of course, into whatever you have in Roth, but who knows? There's a lot of financial, planners and stuff that think in 15 years from now, we might not have Roth, the ability for Roth contributions. No idea if that's true or not, but based on what they're trying to do with the Build Back Better plan, I'd agree they don't like Roth and they want to tax you. The government always wants to tax you as much as they can. So lifetime tax-free growth is just completely counter to our politicians' way of thinking. Any questions here on this? Does this make sense about the catch-up contributions? It's just an idea of what to do with that extra $6,500 and whether to go traditional or Roth. Okay, guess that's good. Okay, and I put this out because some people, I don't think anybody currently on this, but actually, no, Karina, they have a significant other in the military, and the incredible tax advantage we have in the military is something I just had to specifically point out. How much of the pay, and especially if you're in California, where it's housing costs are so much. It's the BAH, which is a housing allowance. It's variable depending on where you live, and so considering how expensive California is, you're at least a third of your income is tax-free. So you'll never be in this low of a tax bracket again. So to me, I would be going all Roth if I were in the military still. Sadly, like for TSP, they didn't have Roth for a number of years, but now they do. And especially when you're early, I've got this an example of an O2, which is in the Navy, it's a lieutenant junior grade. In all the other services, it's a first lieutenant. But it's pretty good money if you look at it, how much they're actually making, and then look at how little is taxable. Down on the bottom, it's the O3, which is that's the O is officer, 3 is a third rank, so that's a captain in the Marines, Air Force, and Army, and a lieutenant in the Navy. But not bad cash. And now check out how much they're getting taxed, how much of their money is taxable. It's amazing. And if they're smart, they don't pay any state taxes, because you can easily get your residents to become a resident. What I did, I was a Washington State resident my entire time, and then in the military, even though I initially was a California resident when I went in, then I got stationed in Washington, because California won't tax you if you live out of state where you're military, but if you get stationed in California, yep, they're going to start taxing you. So I purposely did that, and then I was stationed in California several times and never paid state taxes because I was a Washington resident. But it's significant savings right there. But look at the difference. I'm comparing a civilian, and I'm using them as civilians getting the HSA contributions. Military doesn't, because they don't have that ability, since we have free healthcare. But look at the difference in the taxable income between a civilian in California making the same wages as an O2 in California, and then this you gave the example of putting all their money into pre-tax, 401k. Even with all the money to free $20,500 to traditional 401k, they still have $13,000 more of taxable income than the same person in the military. Pretty crazy, yeah. Look at these effective tax rates. And here's the same example. Just now it's with an 03, when they make rank hit. So that's with somebody at 4 years, the minimum they're going to make. This doesn't account for any other pays they get, but. Okay. Like I said, one of the things I want to talk about is too often people just look at this year, and then if you're just deferring all your taxes, you could end up with this huge, 97% or whatever, in traditional, and then now we're going to go into the tax bomb. Don't go all Roth though, because you want traditional as well, especially if you're charitably minded. And just the fact of the tax deduction you get every year, you at least want to fill up that tax standard deduction minimum when you're in retirement to convert, because you're not paying any taxes on that money anyway. But we're going to go into some examples of potential tax bombs, and what that way people think about, even though you're young, you can think of what you could potentially be hit on in RMDs, the required minimum distributions, as you get older. So I just did a quick example. Say somebody contributes 20.5K for 30 years, spread out 2 payments a month, 8% rate of return, which is kind of standard people use. Balance gets to 2.56 million. And then I assumed you grow at 3%, because maybe you're taking money out, you went more conservative. And then it continues to grow though at 3% till you're 72, when you have to take required minimum distributions. And then by the way, required minimum distributions, that each year that percentage gets higher, because they're trying to get your tax money right before you die. So that percentage though keeps going up because it's based on life expectancy. And each year you get older, obviously you're shorter life expectancy, so that's a larger percentage. So this is a growing tax burden, likely. But now we'll look at what your RMDs would be on that balance of 3.44 million. I have the lifetime tax table so you guys can see there. But your RMD would be 125.4K. So aside from that, assuming that's your only income, but you probably have other things, Social Security, etc., or maybe rental income, this would be like the minimums you're gonna pay. By the way, RMDs, as a note, are required for all types of qualified accounts of 401ks and IRAs, except for the Roth IRA. Roth IRA is the only one that you really have control of and can determine when you want to withdraw money. Even the Roth 401k, even though it's Roth money, you still have to pull it out as RMDs.
Hey, Alan, just a question
Yep.
on that. So is the policy, is that a rule that can change with if like different legislation can be passed? So
Absolutely.
like obviously this is the best possible plan we can make. And as of today, Roth IRA money would be the last dollar you spend in your life, but that could change in the future. Is that true?
That could change. I don't think they're going to change the fact of any money you have in your Roth. That money will be grandfathered in, if that makes sense, except for, as you could see, they're trying to make it so that anybody, and these people have huge Roth bills. This is all Peter Thiel, what they're coming after.
Right.
If they have over 20 million, they're forcing them to take half of that, taking distributions out of that.
Right.
Yes. So they're trying to do that. But for the average person, like for this amount of money, they wouldn't, that's not that high. So I would expect that you could still control, for your whole entire lifetime, regardless of what administrations do. RMD ages will change. They went from 70.5 to 72 recently. And actually that bill in the House recently is pushing that even higher, to which they're trying to get it up to like 75 years old, which would be great, but we'll see. That's not law. But we'll see if that does happen. Does that answer your question? Sometimes I feel like I don't answer the question that was asked.
It does.
Okay.
I mean, yeah, we can only, that's why we got to keep on top of this stuff. Cause like, it changes. So we have the best laid plan today, given the information that's in front of us.
Exactly. And that's it. Hey, we're making predictions, like you're doing the best that you can, but some planning now could save you hundreds of thousands of dollars in taxes later. Okay, so here's the going in further into that example of where you had that that RMD of 125.4K. I assumed you also had Social Security, which you would have to start collecting at least, even if you push it out till 73K per month, and no other income, which is not always the case. A lot of people have rental income, et cetera, but this is a minimum. Bam, look at, and I'm using the Tax Cuts and Jobs Act because we know that's sunsetting. So this is likely what the tax rate would be. And you're looking at, 28%. You're in the 28% tax rate. And that's going to be consistent and maybe even higher as your years go on. Does this make sense? I know there's a lot of numbers and stuff there, but just showing how suddenly you're just shoved into this 28% tax bracket if you didn't do any planning ahead of time. And okay, another tax, IRMA, that's the income related monthly adjustment something. Anyway, it's Medicare. How much your Medicare premium will go up based on your income, and it can be significant. So suddenly you went, if somebody was single and they had less than 91K, they'd be paying only 170 per month. Bam. But this, because of that RMD, now they've locked in 442.3 premium every month. So it's significant amount of, you're paying an additional over $5,000 of tax because you bumped into this IRMA bracket. Does that make sense? That's something people often overlook as well. Okay, here's another, this might sound dark, but the fact is, normally one spouse passes away before the other. And if you both had, I basically just doubled up those numbers, but if you both had that much money and then all of a sudden it's single, now look at your tax brackets. When you're suddenly shoved into a single, back to single tax brackets, you're going to be at the 33% tax bracket for the rest of your life, until you get married again, if that was the case. But this is just a thought, and this also goes into, we'll get into the Roth conversions, but considering, are you planning for 2 people, 1 person, or 0 people? And that's another separate topic, kind of. Okay, here's another.
While we're on this topic, what are your thoughts generally on life insurance and advice, therefore?
I think in general, I think for the vast majority of people that term life is the way to go, and then invest the difference. And because once you're financially independent, you are self-insured and you don't need to. If you don't have any dependents, you don't need insurance. You need life insurance when somebody else is dependent on your income. If you're single and have nothing, I wouldn't have insurance. Like, why do you need that? Unless you're making so much money that you need another tax shelter, max out all these other things and self-insure quicker. But if somebody's,
thank you.
And okay, so this is another example of what people, when they get near retirement, right? They don't want any debts, so they consider like, hey, I'm just going to pull out a bunch of money and pay off my mortgage. Well, if you did that and you didn't pay those taxes, you just pulled out 330. You could have a nearly $66,000 tax bill, and you push into a higher tax bracket. But you'll need that much money on tax day. And what if you didn't account for that? Then you're gonna have to pour more money out, which you can also have to pay taxes on. It could be very brutal. So it's just, people need to be, people can really screw themselves up if they're not doing proper planning with money. Does this make sense about the mortgage, paying off the mortgage with a traditional distribution from a traditional account, like a traditional IRA or 401k? Okay, now getting into those examples were literally just showing how you could get, have significantly higher taxes in retirement throughout the rest of your retirement. And now options for preventing that. And those are really Roth conversions, pushing out Social Security until 70, and then capital gains harvesting is another thing you can do during these gap years where, say, you had no income, you could sell off a certain amount of equities, and those capital gains would have 0 tax on it up to a certain number. It's pretty cool. Roth conversions. So this is what I said is people's income goes up and you're like, hey, let's start going more all traditional. You can then, when your income drops, start moving that. You move the, roll over the 401k to the traditional IRA, and then start converting a certain amount of money to Roth. You want to limit that, and then you wait 5 years, because those are it all depends on age, but there's 5-year rules with the Roth, but you should already have a decent amount of money in there, and then it's tax-free for life. So you can do that and start moving. We'll go through this example of how much you could move using a certain low tax bracket. You could move money every year and get, start moving a decent amount of that 200, I'm using the same numbers of that person that had the 250 in 2.56 when they were 60, and they could do 12 years of conversions. They could move over nearly $600K that'll be tax-free for life while they maintained their 12% tax bracket or 15%. Significant, huh? And then you've dropped your RMDs long-term for life, plus you have 600K of tax-free growth forever. So that's the trick of doing Roth conversions, taking some of that traditional before you hit RMD age, where you're forced by the government to take the money out. A lot of numbers there, but hopefully it makes sense. Yeah, here's another example of capital gains harvesting. I gave an example of, hey, you bought stock at $10, it grew to 100. Hopefully that's nice, but that means $90 of that is capital gains. If you didn't have any income, you could sell nearly $55,000 of that stock. Because this is the thing, you've got that of gains, because you've got the 12,900 is that standard deduction, right? So you can go sell that much and pay $0 in tax, assuming you don't have any income. So that's just something that's pretty awesome that people can take advantage of potentially if you retiring early, or you're on sabbatical, say for a few years or something. Another way, California has the highest taxes, so establishing residency outside, and then you do those conversions, you will minimize all these taxes as well. By the way, did you see the bumper? Just by only shifting your residency from California to Nevada on all the retirement calculators, you get your chance of success increases by 5%. That's pretty significant, huh? Okay, these are the age-related rules with respect to the 401k. If you if you withdraw before 59.5, you'll pay income tax and a 10% penalty on traditional IRAs. As we discussed before, you can start pulling out money at 55 from your 401k if you retire from that company at 401k, but only that has to stay in that 401k. Requirement of distributions are 72 right now. And then we'll go into, like I said, 5-year rules on Roth later. It's complicated and depends on whether you're 59.5 or not, and several other things, and whether it's contributions, conversions, or earnings. But as discussed, here's kind of like, it's not a third, it won't be a third, and third. That was just the easiest way for me to create the pie chart. But you want some of each. If you want to buy, you retire, you want to buy an RV or something like that, you don't want to use all traditional IRA, and that would bump you way up in that high tax bracket because you're paying taxes on all that money. So having this flexibility of being able to use some brokerage account, maybe some Roth IRA, it just gives you flexibility to really live your life the way you want to. Does anybody have any questions or any comments about this? Or thoughts about it? Okay. Okay, just got some quick questions. If you guys don't, we're at the end of this, and I know we're a minute over. But did this make sense to you? Is there, if not, what could we do better to make it hit the mark? And then do you feel like you can take this helps you make some steps on what you want to do with your own allocation of your 401k and or IRA, whether traditional or Roth?
I have a question.
Yep.
So I missed your last call or two. So are you saying that we should enroll into the Viasat Roth, IRA Roth, even if we have a traditional IRA outside of Viasat? Because I know the Roth, it helps with the tax implications, right? But I'm not involved. I'm enrolled in 401k ESPP, but I'm not enrolled in the Roth.
Okay, well, and this, I guess I don't have the answer. I don't know your exact situation, Chanson, and it's dependent. But the point is, and you could, with the Viasat 401k, you can do some traditional and some Roth. You can split that up. And that's the whole point of this is, hey, we're in relatively historically low tax rates. So you might want to put some of each to help filling up that Roth bucket since you only have traditional. Did you say you only have a traditional IRA as well?
I do have one, yes, but it's it's separate it's just a separate account with American funds.
Okay, yeah, exactly. And everybody should have an IRA. One of the things, Chance, and we'll have to talk about those backdoor Roth, because I'm a big fan of the Roth IRA. Everybody should have a Roth IRA, even if you just immediately open one and get $1 in there.
Right.
Because it has to do with these 5-year rules and long-term flexibility. But if you already have a bunch of money in a traditional IRA, that's where we get into pro rata. And my last topic really went into explain that in depth. If you guys want, we could go over it now. Otherwise, I did offer to redo these topics for the next 3 weeks. April is Financial Literacy Month, so I know people missed the first, couple, and there's new people joining. So if you guys are interested, I'll redo. I'm going to cut the first one in half because that was too much information for an hour, and then do the next one where it goes into the pro rata rule and how to actually avoid that. Because what you could do, Chanson, if you were interested in getting a Roth IRA and doing the backdoor IRA conversion, you could take that traditional IRA and put that into the Viasat 401k. And then you'd have zero balance in your traditional IRA. And that whole thing I was saying, where you could shove $6,000 in the traditional, backdoor to the Roth, pay zero taxes. That's how it works. But if you got a lot of money in the traditional IRA that you haven't paid taxes on, you'll pay proportional tax on that $6,000 that you contribute and move over in proportion to what you have in that traditional IRA that hasn't been taxed. So say you have $94,000 in the traditional IRA and you add $6,000 of after-tax money, but $94,000 of that is traditional and pre-tax. Well, when you move that $6,000 over, even though you've already paid taxes on it, the IRS doesn't see that. They see it. It's just coffee creamer. It's like coffee creamer in a cup of coffee. It all mixes together, and so 94% of that money you haven't paid taxes on, and you'll pay taxes on 94% of that Roth conversion. Does that make sense?
Yeah, it does.
Okay. And we could go into, like, I tried to answer it really quickly, but I've got specific slides on it that walk through exactly how that works. So my thought is, don't just shove in all traditional. The whole point of this is consider what's the right thing for you. Whether doing some for all, some traditional, and don't just think about this year. Think about long term. What's right to fill up some of each bucket so you have long term flexibility on how you live your life. Make sense?
Yep.
And these all we already. I'm not going to go into these since the person that asked them was not here. But the next official topic is going to be ESPP and RSUs and going to capital gains. And then these are potential topics, but we'll see what people are interested in. Okay, any other questions? Or anything we want to go back over? Sounds like that's it. Okay, thanks everyone. Hopefully you found this useful. And if you have any recommendations for how to improve, let me know.
Thank you, Alan.
Thanks, Alan.
Thanks,
Yeah.
Phil.
Thanks. Have a great weekend.
Yeah, Alan.
You're
Have a
welcome.
great weekend.
You too. Thank you.